What's the difference between an FHA and a conventional loan? I'm Matt Wilson, mortgage advisor with New American Funding, and today we're going to talk about the pros and cons of each. So, on a conventional loan, there's no funding fee versus on FHA loan, there is a funding fee of 1.75%. So, effectively, if you put down the minimum 3.5% that goes into an FHA loan, half of that's getting chewed up right up front as a funding fee that goes straight to the FHA. It gets tacked onto your loan amount. So, effectively, it just negates half of the down payment that you put down. Conventional doesn't have that. If you're a first time home buyer, you can have as little as 3% down. If you're not a first time home buyer, it's as little as 5% down. Um, Mortgage insurance is going to vary between the two because, like on conventional, mortgage insurance is going to be based on several factors like your credit score, your debt to income ratio, where the property's at, the loan amount, things like that are all going to impact it. Whereas on an FHA loan, it's just 0.55%. If you're putting minimum down, that goes down a little bit if you were to put down more than 10%. But another thing about it is the mortgage insurance is there for the life of the loan on an FHA loan. So unless you pay off the loan or refinance the loan or something like that, you have that mortgage insurance. It's not going to fall off at 80% loan to value like the conventional option does. Um, Now, some differences as far as qualifying goes, like on a conventional loan, technically the minimum credit score is a 620, but most of the time, unless there's a really specific need for it, if you're below a 680 or 660 or so, I'm going to lean more FHA probably because the pricing is just going to get pretty ugly on a conventional if you get down that low, especially if you have to have mortgage insurance. Those mortgage insurance providers don't love that sort of scenario with low credit and low down payment. Um, on an FHA loan, if you've got 10% to put down, you can technically go down to a 500 credit score, which is pretty crazy. If you're wanting to do the minimum 3.5%, then your minimum score is a 580. Again, like you can actually do that pretty reasonably compared to the 620 on a conventional loan. All right. Now, next thing, seller credits. If you're trying to get the seller to help you out on closing costs, if you're doing a minimum down on a conventional loan, your cap is 3%. If it's minimum down or anything down on an FHA loan, it's 6%. So you can go a little further with your seller credit on an FHA loan than you can a conventional loan. Now, another thing too, debt to income ratio. I don't have this listed on here. Debt to income ratios will let you go typically a little bit higher on FHA, so you might qualify for a few more dollars on an FHA than a conventional. Last big thing though is when you're writing an offer, you want it to be as competitive as possible. A lot of sellers will favor a conventional offer over an FHA offer just because FHA's typically got the stigma of lower credit, lower down payment, stuff like that, which makes it a riskier loan, and sellers know that. So, a few things to consider there and differences that I did want to go through before we jumped into actual numbers themselves. All right, moving right along here, though. Uh, First thing that we're going to do is we're going to compare the different rate options. With my company, I've got the ability to price out across several different lenders so that I can make sure that everybody's getting the best deal possible from a rate standpoint for their scenario, plus the best deal possible overall. Now, if we're to compare FHA at no points, so the way we read this is you can have any of these rates right here, but any of these rates are going to cost different amounts. And that cost is in this other column over here where my mouse is. And basically what that means is like at 6.99, if priced out in this scenario today with decent credit and $300,000 loan amount or purchase price, then I would actually be paying you $214 towards your closing costs. So as it gets more expensive, generally speaking, you're going to wind up with lower interest rates, which obviously means lower payment. So we have to figure out what we're optimizing for whenever we're structuring up somebody's mortgage for them. The first thing we need to determine is, are we prioritizing your monthly payment? Are we prioritizing your cash to close, or are we going to prioritize the total cost of the loan over time? Sometimes you can have it all, but for the most part, we need to figure out which one matters the most. If for example, you've only got $25,000 to use for your down payment and closing cost or your total cash to close, then in that situation, we're going to probably have to prioritize the cash to close and not be able to prioritize your monthly payment quite so much. Um, but anyway, that's where we're at right now on an FHA loan. Now, if you were to take it conventional, then on the conventional option here with no points or roughly the same lender credit, it's going to be 7.5. So you're probably looking at like, holy crap, higher interest rate. So I should totally go with FHA. Not so fast. Let's take a look at how that shakes out. All right. So first column here, that FHA loan we just looked at. The FHA loan we were looking at is 300,000 with 5% down. I know I said the minimum is 3.5, but I wanted to make sure that we had a apples to apples comparison and weren't playing with down payments across these different options here. So we're doing 5% down across the board here. Now you'll notice the loan amount though is not the 285 you think it should be, because that 1.75% funding fee gets thrown in there. So your loan amount goes up. Interest rate 6.99, like we just talked about. Monthly payment, including estimated tax and insurance, mortgage insurance, whole 9 yards, $2,332. Not too shabby, but it is what it is. Cash to close about 24,000 right there. It's going to include down payment and closing costs. So remember before I said you could have the seller pay up to 6%. Well, you have to pay your own closing costs or your own down payment. I'm sorry. The closing costs, you can only have a credit for as much as they actually are. So that's what we're looking at for the first scenario. Now, conventional, like I said, 7.5% down. You'll notice though the loan amount's cheaper because there is no funding fee. Next piece of this is the payment. The payment, even though the interest rate is that much higher, the payment is within like $12 of the FHA option. Reason being, lower loan amount, no funding fee, and mortgage insurance with excellent credit is going to run you cheaper on conventional than it will FHA, and the mortgage insurance will fall off. As far as cash to close goes, you're within a couple $100s. So in this scenario here, if all other things were equal, you would actually wind up potentially in basically the same boat by having an interest rate that's effectively 0.5% higher, because we're considering the total cost of everything and not just the interest rate. This is why it's so important not to just go online and search for an interest rate, but to actually understand the total cost of what it is that you're doing. Now, to drive that point a little bit deeper, remember I said it's a 1.75% funding fee. Well, if you actually paid that, here's what you're looking at here. Like if you paid that in points on a conventional loan, now you can't roll that in like it would happen with a FHA loan. So bear that in mind. This would be a scenario where we're optimizing for monthly payment, not cash to close. But in that case, you got $300,000 here. You got 285 as your loan amount again, and then you got 6,875 now as the rate. Now I'm basing that on this right here. That's as close as I could get us to 1.75. So roll with me there. That being said, your monthly payment is now about $110 cheaper than it would be on FHA. Your cash to close is higher because you're paying 1.75 extra, but the effective cost of the loan to you is the same as the FHA as far as that 1.75% extra money getting paid. So with that being said, that's an argument that I'll always make there, depending on how much cash to close somebody's got, is like, would I pay the points to go conventional this way or would I not? Now, if we look at it over time, so monthly payment difference, regular conventional no points is your highest monthly payment. However, over 60 months or 5 years, if you don't refinance or anything, even though you've got a $10 higher monthly payment or $12 higher monthly payment and $200 higher in total cash to close, you come out ahead over a 5-year term by $2,200 here. So FHA had a cheaper interest rate, if you remember, but conventional comes out cheaper even though its interest rate's higher. Again, this is all assuming somebody with excellent credit. This is going to change, but scenario to scenario. I'm just trying to give you like one certain example. Now, if you paid the points, the savings over 60 months is going to be even higher. You're looking at like $6,000 saved over the next 5 years. That's not small money. Now, over 10 years, things get even crazier. Over 10 years, you actually start saving money to go FHA instead of conventional, if you're not paying any points. But will you have this mortgage in 10 years? I don't know. Statistically, probably not. If you paid the points, you're saving money to go conventional. So all that to say, it's very important that we're comparing everything involved here. As you can see, there's differences that have to be considered for if we are optimizing for cash to close or the monthly payment or the total cost over time. And how long is that time? Because as you saw there, the one that's the most beneficial option is going to sometimes change over time, depending on your time horizon. So that's why whenever planning out your mortgage, we want to make sure that we've got all of those things considered so that you know for sure you're getting the best deal for your full financial picture. That being said, if you look down in the description, you can schedule a call with me if you've got any questions for your specific scenario. In addition to that, you can download your free copy of the ebook, How to Make Getting a Mortgage Not Suck. That way, whenever you buy your next house, it doesn't suck.